The Federal Reserve, also known as the Fed, is a very important part of the US economy. It's like the captain of a ship, steering the economy in the right direction. One of its main jobs is to control inflation, which is when prices of things go up too fast. The Fed does this by setting interest rates. Interest rates are like the price of borrowing money. When interest rates are high, it costs more to borrow money. So people borrow less and spend less. This can help to slow down inflation. The Fed has a group of people called the Federal Open Market Committee, or FOMC. The FOMC meets several times a year to decide what to do with interest rates. These meetings are a big deal because they can affect everything from how much you pay for a mortgage to how much money you make on your investments. When the FOMC decides to change interest rates, it sends a signal to the markets about the health of the economy. If the FOMC cuts rates, it could mean that they are worried about the economy slowing down. If they raise rates, it could mean that they are confident about the economy and want to keep inflation in check. The last FOMC meeting of 2024 happened on December 17th and 18th. Everyone on Wall Street was watching closely because the Fed had already cut rates twice that year. They wanted to see if the Fed would cut rates again. The head of the Fed, Jerome Powell, spoke to the media on December 18th. He told everyone what the FOMC had decided. The FOMC decided to cut the federal funds rate by 25 basis points, or 0.25%. This means the interest rate that banks charge each other for overnight loans went down a little bit. This rate cut was expected by most experts. They knew that the Fed was worried about the economy slowing down. The Fed had started raising rates in 2022 to fight inflation, but now, inflation was coming down and the economy was looking weaker. So the Fed decided to cut rates to try to help the economy grow. When the Fed cuts interest rates, it usually means that other interest rates, like mortgage rates, will go down too. This is because mortgage rates are often tied to the federal funds rate. So, after the December FOMC meeting, mortgage rates went down a little bit. This was good news for people who wanted to buy a house. It meant that their monthly mortgage payments would be a little bit lower. However, even though mortgage rates went down, they were still higher than they had been a few years ago. This is because inflation was still a concern. Inflation is when prices of goods and services increase, and it can be bad for the economy if it gets out of control. The Fed wants to keep inflation at a low level, around 2%. The stock market usually likes it when the Fed cuts interest rates. This is because lower interest rates can lead to economic growth, which is good for businesses. So, after the December FOMC meeting, the stock market went up. Investors were happy to see that the Fed was trying to help the economy. However, some experts were worried that the Fed might be cutting rates too quickly. They thought that cutting rates too quickly could lead to inflation going back up. Overall, the December 2024 FOMC meeting was an important event for the US economy. The Fed's decision to cut interest rates was a sign that they were trying to balance the risks of slow economic growth and high inflation. It remains to be seen what the Fed will do next, but one thing is certain: the markets will be watching closely.